Hi, welcome to this podcast where we're going to be looking very quickly at capital budgets. Capital budgets are where a business gets its long-term finance and money from. So things that could be in there, for example, are debentures, which are a special type of long-term loan. Loans themselves, potentially mortgages if they're buying premises, owner's own funds, sale of shares, and for example, money introduced back into the partnership or assets introduced into the partnership by a partner. Just be a little bit careful when, particularly as a lot of you will be studying both accounting, economics and business. Capital can be a confusing word in finance because it can refer to the owner's own investments only in the business. It can refer to, and in this case, does refer to the long-term investment in the business. And we also talk about capital in terms of equipment or non-current assets. So be very, very careful. Make sure you understand. If somebody says to you capital, make sure that you understand what they mean. Okay, what it is and what it looks like. We've got Abdul Rahman has decided to start a new business delivering food, and he's going to do it during February. On the 1st of Jan, he's going to deposit $10,000 of his own cash into the business. So that would just go in as a inflow of 10,000. And he also introduces a car, and that's valued at 5,000. So although it isn't cash, this is still capital that Abdul Rahman has put into this business. So we're going to include that in the capital budget. And then down in the bottom part of the budget, we have the opening capital. Well, this is a new business. So new business, there is no opening capital. Closing capital is just going to be 0 at 15,000. And then, as with all businesses, that closing capital of 15,000 at the end of February becomes the opening capital in March. He's also going to buy a premises in March, and that's going to take out a mortgage. So that's going to be a 30,000 of capital because that is a long-term loan and therefore a long-term source of finance. We add 30,000 onto the opening capital, so that gives us the closing capital in March, 45,000. And his father has agreed to buy $50,000 worth of shares in April. So again, we class that as capital coming into the company. Opening capital for April has to be the closing capital from March. 50,000 at 45,000 gives us 95,000. So really a very, very simple budget to do. It does link to obviously to particularly the cash budget if the capital's coming in the forms of cash. Something that I've never seen done at A level, but there is normally budgets linked to assets, so there would be a link in there as well. Okay, there's a very simple student question for my students to do and send back to me. And then once you've done that, there's just 2 short bits of theory. Okay, something that gets asked sometimes as a question A level is the order in which we complete the budgets. And it's relatively straightforward because it's quite logical. Normally the first budget a firm would do would be the sales budget because that drives many of the other things. Once you've got a sales budget, you can do an inventory budget of finished goods, and we'll very quickly look at mention inventory budgets in a few moments. And also at that point, we could do something called a trade receivables budget. Once you've got your inventory of finished goods, you can work out your production budget. So if you look back to the video I did on production budgets, we had to do an inventory budget to work out the production. Then you can do your inventory of raw materials, then your purchases budget because you're purchasing the raw materials, followed by a trade payables budget and a cash budget. And finally, you've got the budgeted income statement and statement of financial position, which is also called the master budget. And this would be done last because it needs information from all the other budgets to actually be able to complete. So, for example, you wouldn't know what your budgeted year-end statement of financial position was going to be if you didn't know your closing cash. Put these two budgets on the right-hand side because there's a bit more flexibility with when we do those budgets. We certainly can't do a trade receivable budget before we've done a sales budget, but it doesn't particularly matter that we do the trade receivable budget before, for example, the production budget. And similarly with the capital budget, like perhaps wouldn't make sense to do that before we've got a production budget because we might need to bring capital into the firm to buy new equipment. But it certainly can be done, for example, before we do the purchases budget. So there's flexibility with the two there in red. But the order is pretty much fixed by the fact that it's really driven by how many we're going to sell, working out what we're going to produce, and then working out what we're going to buy. And when we've got that information on what we're going to produce and buy, and we know the timing differences, so we've got trade receivable and trade payable budgets completed, that we can really work out our cash budget for the year. Okay, and just as a little bit of an aside, some additional information, very often the final budgeted income statement and statement of financial position, they're very often called the master budget. Inventory budgets, you'll see an example of an inventory budget on the, as I've already said, on the production budget video I've done. But just a quick reminder, for looking at calculating closing inventory, then what we need to know is the opening inventory, the production, the sales, and we do opening inventory, add production, less sales, gives us closing inventory. And it is possible for students that I teach at the moment that you may also be asked to do a raw materials budget, and the opening raw materials, add the purchases of raw materials, less production, usage of raw materials should equal the closing inventory in a raw materials budget. And a little bit of theory that's quite often linked to production budgets, if it comes up in a question, are what are the problems and disadvantages of running a high level of inventory? Problems with running a high level of inventory, it's much easier for goods to get damaged. If you've got a full warehouse and you've got forklift trucks running around the warehouse, the more goods there are in there, the less space there is for machinery to maneuver, and therefore there's a greater chance of it getting damaged. And many things, even like cardboard boxes, if we leave them standing for too long, the colours on the cardboard boxes might start to deteriorate and people are less inclined to buy them. The more inventory we've got, the more time it takes, and therefore the more cost in locating them. So I've worked in companies where some of the warehouses have been the size of national football stadiums. Okay, it takes a long time for a forklift truck to go from one corner of that larger warehouse to another corner. The more we store, the more we've got to rent capacity, and capacity for storage can be very expensive. And clearly also, if we have a lot of inventory, that's tying up a lot of cash in the business in inventory. And cash is something that businesses have to take a lot of care of. But there is a balance between too much and too little inventory. If firms allow their inventory levels to fall too low, that can lead to what we call stockouts, and that causes a loss of sales and customers. And what we mean by a stockout, therefore, is when we haven't got the goods there when the customers want them. Right, thanks very much for your time. Obviously, if you're one of my students who've got a question, email me. Otherwise, good luck and goodbye.